Welcome back to our Week 2 lecture series. In Part 1, we focused on regulation and balance sheet fundamentals. In this segment, we're shifting towards profitability and forecasting. This means we'll take a look at how banks actually earn revenue, how they manage risks such as loan losses, and how they plan for growth using forecasts of both assets and liabilities. These are critical building blocks for understanding how banks operate in the real world. When we look at a bank's income statement, we're seeing how the institution performs over a period of time, unlike the balance sheet, which is a snapshot of an instant in time. What makes a bank different from most corporations is that its revenue is not driven primarily by the sales of goods and services, but instead by interest earned on loans and securities. Expenses come from the interest it pays to fund those loans, as well as the salaries, the technology, and other operating costs. As you think about this, ask yourself, how does this structure affect the way we evaluate profitability compared to a typical company? The income statement follows a logical sequence. Interest income is the starting point. Subtract from that interest expense, and we get net interest income. After accounting for provisions for loan losses, we then add non-interest income, subtract non-interest expenses, and arrive at a net profit or net loss. This breakdown is important because each line item tells us something unique about risk, efficiency, or resilience. Consider this for a moment. Which of these line items would be most vulnerable when the economy shifts? Interest income is the primary revenue engine for banks. Loans are the biggest contributor, followed by interest from securities and other instruments. Even interbank loans and reverse repos can play a role. This reminds us that banks function as both lenders to households and businesses and participants in the broader financial markets. A useful exercise is to consider how changes in interest rates ripple through all of these income sources. On the flip side, interest expense reflects the cost of generating that income. Banks pay depositors, they pay interest on borrowed funds, and they even incur costs when accessing emergency funding from the Federal Reserve. The spread between income and expense is crucial. Connect this back to your understanding of the balance sheet. Assets generate interest income. Liabilities and borrowings create interest expense. Profitability depends on managing both sides of this equation effectively. The difference between income and expense gives us net interest income. This measure is central to banking performance. Analysts often calculate the net interest margin, which expresses this result as a percentage of earning assets. Think of net interest income as the bank's core business profit from its traditional lending activities. If you were comparing two banks, how could differences in their margins reveal strengths or weaknesses in their respective business models? The provision for loan losses is one of the most telling items on the statement. Provision for loan losses is simply money set aside to cover expected defaults. It reduces current income, but it also reflects management's outlook on risk. In boom times, provisions may be lower. During recessions, these provisions will rise. Think about how this links to regulatory expectations as well as to your own assessment if you were a financial analyst. What does a change in provisions tell you about the bank's risk environment? Fortunately, banks do not rely solely on interest. They also generate fee income from wealth management, cash management, and other services like deposit account charges. Non-interest income diversifies the revenue stream further. This is an area where banks have innovated, especially as margins are pressured by competition and regulation. As a student, it's worth considering this. How might growth in non-interest income change the risk profile of a bank? Every business has operating costs, and banks are no different. Salaries, training, technology, marketing, and facilities all appear here. Non-interest expense is often referred to as overhead, and managing it efficiently is vital. Connect this back to the concept of profitability. High expenses without corresponding income will erode margins. As you look at different cases, consider how banks balance investment in technology with the need to control costs. Chapter 7, Forecasting the Balance Sheet. Forecasting is about planning for the future. Banks cannot simply operate in the moment, they must also anticipate growth, risks, and future funding needs. In this chapter, we explore how banks use the balance sheet as a blueprint. Think of forecasting as a form of storytelling. Where does the bank want to go, and what mix of assets and liabilities will help it get there most effectively? At its core, bank profitability comes from net interest income. Both income and expense are tied to the balances on the balance sheet: loans, deposits, securities, and borrowings. Fee income is important, but it's not usually the main driver. The key here is that forecasting is not abstract. It's grounded solidly in the numbers already available on the balance sheet. The balance sheet is the starting point for planning. Assets are the uses of funds, and liabilities are the sources. Loans and deposits dominate these categories. As interest rates change, both sides shift in value and cost. Focus on this relationship. The balance sheet isn't simply an accounting document. Instead, it's a map of how the bank will earn or lose money. Assets generate interest income, but they also create risk. Loans, securities, and even interbank placements all contribute to revenue, yet each has a different sensitivity to interest rates and credit risk. When forecasting assets, banks must decide how much growth is realistic as well as sustainable. Reflect on which assets you think are most resilient in different economic conditions. Liabilities are the other side of this equation. They provide funding, but they also carry interest costs. Deposits are usually the cheapest and most stable source, but banks may also rely on repos, bonds, or even the Federal Reserve in some circumstances. When forecasting liabilities, we essentially are predicting how the bank will finance its ambitions. Consider this question. What happens if those funding sources are suddenly unavailable? Equity is ownership capital. It comes from common stock, preferred stock, and retained earnings. While equity does not require interest payments the same way debt does, it can involve dividends and shareholder expectations. In forecasting, equity serves as a cushion for growth and risk-taking. Think of it as the safety net that regulators and investors alike are watching very, very closely. The process begins with projecting asset growth, especially loans. Historical data and strategic objectives guide these estimates. Once assets are forecast, the bank must figure out how to fund them. This is where liabilities and equity come in. The rule is simple but powerful. Assets must always equal liabilities plus equity. Think carefully about what could throw this balance off in real-world situations. Sequence of forecasting. The order matters. Forecast assets first, then match those with funding sources. This sequence reflects the fact that growth objectives drive everything else. A bank that seeks to expand lending must secure the deposits or the borrowings needed to support those loans. As you consider this, think about how different banks might approach forecasting depending upon their strategy. Community banks versus large multinational banks, for example. Loans are usually the centerpieces of asset forecasts, but securities and cash balances also matter. Forecasting assets requires assumptions about demand, credit conditions, and interest rates. Consider the uncertainties here. No forecast is perfect, but thoughtful assumptions can make them very powerful as planning tools. Once you know the asset goals, you next have to fund them. Deposits are the first line, but those may not be enough. Banks then turn to interbank loans, debt issues, or even equity offerings. Each choice comes with costs and implications for profitability. The challenge is balancing affordability, stability, and growth. Think critically about the trade-offs. Cheaper funding may come with higher volatility, while equity is safer but dilutive in nature. In the end, the balance sheet must, of course, balance. If liabilities exceed assets, then there is excess funding that needs to be invested. If assets exceed liabilities, there's a funding gap that must be filled. Balancing is not simply arithmetic. It's about ensuring that the growth strategy is realistic as well as sustainable. This is where management judgment and regulatory oversight intersect. We have reached the end of this segment. We've explored profitability through the income statement, considered how banks protect against loan losses, and also looked at how they forecast the future through balance sheet planning. As you review, I encourage you to not only commit the mechanics to memory, at least somewhat, but also reflect on the bigger picture. How do these tools equip banks to survive and thrive in constantly changing conditions? As always, reach out anytime you have questions about the course content. I'll see you online.